Today, let's talk about how you can save taxes while making the most of your investments. Tax season can feel overwhelming, but don't worry, I'm here to simplify things for you. Smart tax planning isn't just about paying your dues, it's about keeping more of what you earn. Now let's break it down. We have two tax regimes, the old regime which offers deductions and exemptions, and the new regime which has lower tax rates but fewer perks. Choosing the right one depends on your financial situation. Let's talk about tax savings investments, because who doesn't love saving money? Under the old tax regime, Section 80C is your best friend. You can claim up to 1.5 lakhs in deductions by investing in ELSS, PPF, EPF, NSC, Sukanya Samriddhi Yojana and tax savings fixed deposits. Remember, 1.5 lakhs is the total deduction limit across these investments. If you have a home loan, there's good news. You get tax benefits under different sections. The principal repayment falls under Section 80C, allowing a deduction of up to 1.5 lakhs. Interest on home loans is deductible under Section 24B with a limit of up to 2 lakhs per year for self-occupied property. Additionally, under Section 80EEA, first-time home buyers purchasing a property valued under 45 lakhs can claim an extra 1.5 lakh deduction. However, in the new tax regime, Section 80C deductions are not available, though the Section 80EE benefit still applies. Insurance is another great way to save on taxes while securing your future. Health and life insurance premiums offer tax benefits under Sections 80D and 80C in the old regime. It's a win-win. You protect your family and reduce your taxable income at the same time. So which tax regime should you choose? Here's a pro tip. Even in the new tax regime, employer NPS contributions, EPF and gratuity remain tax-free. Don't ignore them. Under Section 80CCD2, employer NPS contributions are tax-free up to 10 to 14%, while EPF and gratuity continue to enjoy tax exemptions. Salaried individuals should also note that house rent allowance or HRA is exempt under Section 10(13)(a) in the old regime, but not in the new one. The HRA exemption is based on the lowest of three factors. 1. The total amount of HRA received. 2. 50% of basic salary plus dearness allowance if living in metro cities, or 40% for non-metro cities. 3. Actual rent paid minus 10% of basic salary plus dearness allowance. So which tax regime should you choose? If you have investments like insurance, a home loan, PPF or ELSS, or even if you're paying a high rent, the old tax regime lets you claim deductions. The new regime offers lower tax rates but no deductions, making it ideal for those with minimal investments. Choosing the right regime depends on your financial goals as well. Let's talk about capital gains. Selling an investment for a profit incurs a capital gain, and your holding period affects the tax you pay. Short-term capital gains (STCG) apply when assets are sold quickly. For equity shares and mutual funds held for less than 1 year, the tax rate is 15% flat plus cess and surcharge. For debt mutual funds, gold, real estate and others held for less than 3 years, gains are added to income and taxed as per your slab with no exemptions. For long-term capital gains (LTCG), the taxes are different. For equity shares and mutual funds held for over 1 year, the tax is 10% on gains exceeding 1.25 lakhs, while the first 1.25 lakhs is tax-free per financial year. For debt mutual funds, gold and real estate held for over 3 years, the tax rate is 20% with indexation benefits, adjusting for inflation to reduce taxable gains. To optimize taxes, sell equity investments strategically to keep LTCG under 1.25 lakh per year and avoid tax. Use indexation on debt funds and real estate to lower taxable gains and plan asset sales based on holding periods for lower LTCG rates. Here are 5 tax filing tips for beginners. 1. Choose the right ITR form. Use ITR 1 if you are a salaried individual, ITR 2 for capital gains or rental income, and ITR 3/4 for business owners and professionals. 2. Maximize Section 80C deductions. Utilize the 1.5 lakh limit for all tax savings investments to reduce your taxable income. 3. Keep financial records handy. Maintain Form 16, bank statements, salary slips, investment proofs, and capital gains details for smooth filing. 4. Seek help when needed. If you're unsure about tax filing, ask in the comments or consult a tax professional to avoid mistakes. 5. File before the deadline. The tax filing deadline is July 31st. Submitting on time prevents penalties and last-minute stress. Remember, tax planning is key to maximizing returns and wealth creation. Understand the rules, use deductions, and reduce your tax burden. Drop your questions in the comments and follow us for more tax-saving tips. Happy investing!
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.